I'm Jerome Christensen. I'm a mortgage broker and an insurance agent, and I'm joined by my co-host, Neil Joseph. Today,
Hello there.
we're going to touch on the topic of fixed rate versus variable rate mortgages.
Hey, Jerome, how are you doing?
I'm doing very well. How are you?
Great. Well, doing good, and a great choice for today's topic.
Yeah.
I think it's very timely.
It is. By the time this airs, we will have already heard what the Bank of Canada's decision is, but clearly we're recording this ahead of time, so we don't know what the Bank of Canada is going to do yet. So maybe at the end, something that we can do is make a little bit of a prediction or a friendly gestured bet and see which one of us wins by the time it airs.
Yeah, for sure. That'll be fun.
Okay. So, fixed versus variable rate. Everybody talks about it. Why is it such a tough decision? Why does it matter?
I think it's a Canadian thing.
Oh, okay. Okay.
And I guess it's driven by the fact that how our mortgages are structured. Like, we don't have an option to take something for a 30-year term and forget about it.
No.
So we keep coming back to the same discussion every couple of years.
Yes. Yeah. At renewal time, right? What do I do?
Oh, yeah.
Which is the better option to take?
Yes, at renewal, and also when there is a significant change in interest rates.
Yeah. Yeah. We're seeing some renewals coming up in 2025. Have you heard roughly how many renewals are going to happen?
I don't remember the exact dollar figure, but it is like somewhere about 55% of the mortgages existing today are going to come up for renewal in 2025, 2026.
Yeah.
So, yeah, well, you could say half the Canadians having a mortgage,
yeah,
will undergo this exercise.
I read something, I can't remember where, if it was a Globe and Mail or if it was just some other article, but it said approximately 1.3 million mortgages are going to be coming up for renewal in the next year and a bit. That's crazy. That's a lot of mortgages. Everybody is going to be like, what do I do? Fixed, variable.
Well, for many, it may be, well, many people may not be even thinking about it. I'm sure there are quite a few who are.
Yeah.
But a lot of people are probably just used to the idea of signing up for a 5-year term, a fixed term.
Yeah. Yeah. So is it on the level or on the basis of importance, where would you say choosing the rate and the term kind of comes in? Is it like a 10, it's really important, or is it more like a 7?
Well, it all depends on what your financial goals are and whether the decision you're making helps you meet or go towards or progress towards those goals. It is whatever decisions we are taking, whether we're choosing fixed, variable, or both in some way, it is a forecast of something which is yet to happen. We don't know what the end results might look like just looking at the mortgage and the interest cost. But then our life is not just centered around the mortgage.
Right? Well, yours and mine is.
Yes, but not just my mortgage or just your mortgage.
That's true.
There is more at play.
Yes.
So it is an important decision, but not just the sole focus of that decision.
Mm-hmm. Mm-hmm. So maybe another way that we could add to that is, as always, it depends, right? Whether or not a fixed or a variable is better for any individual. And maybe using the word better is even not the best choice of words, because it really does come down to your goals. Some people may have goals that are very long-term, and the mortgage component of it at this time may not be high on the list, right? It might be just simply managing to live, right? So the lowest payment is what they need. Whereas others are a little bit more strategic in what the approach is.
Yeah, just to give an example, So for somebody who has bought a home, who's carrying a large mortgage, and a significant part of their household expense or outlay in terms of cash flows towards the mortgage payment, yes, it's probably a key decision for them. Or for somebody who has maybe purchased a home 20 years back, they just have a small balance on the mortgage. A choice between variable or fixed may not make a lot of difference in their scenario or in their scheme of things.
Yeah.
So it kind of depends. Again, just an example, right? The quantum of the mortgage or the amount of mortgage makes a difference in the weightage that you would provide to that decision.
Yeah.
And again, there are a lot of other factors. So it is more of an individual discussion rather than a generalized statement that you or I can make.
Yeah.
But maybe during this talk, we focus on some of those common things which anybody going through this exercise needs to know and can take into consideration.
That's a great idea. So let's start with one of the first things. Let's talk about the types of rates that there are. And I know that we've kind of done this a little bit before, but today we're going to be focused on what the rate type is and maybe the beneficial aspects of it. And some of the cons as well, right? Because we're doing a bit of a comparison here. So a fixed rate. The definition by all standards is it's the interest rate that is locked in for a period of time. And generally speaking, that also means that your payments are going to be locked in for the same period of time. Now, there are some pros with that. Do you want to give me one to start?
Well, payments are fixed, so there is a predictability in terms of what to expect on a monthly basis.
Yep.
No surprises for the length of the term.
Yeah. So you're not guessing what's going to happen in a month, what's going to happen in 2 months, or anything like that. A second pro could be that it's stable, which goes hand in hand with predictability. In effect, you're basically looking at saying, I'm going to pay this amount for X period of time. So fixed rate generally means same payment and predictability for the amount of time that you've chosen.
Which brings us to peace of mind, which is a natural outcome of predictability and stability for somebody for whom mortgage is a big expense.
Yes. And so that peace of mind would probably be most beneficial for people who may lean a little bit towards the risk-averse type. They're foregoing the potential of savings, and I'm not saying it's guaranteed or anything. That's why I'm using the word potential, because there could be potential savings by choosing a variable rate, but there's no guarantee. And so this stability and predictability just simply takes it off the plate, right? This is what you're doing. All right, I'm set. I'm good to go for 24, 36 months, 60 months, whatever the case is.
Yeah.
Any cons?
Well, typically there is a cost to that predictability or that stability, which usually means a slightly higher interest rate than one may, again, I would say, usually get with a variable rate mortgage.
Yeah. And that's, I think, really important to distinguish, is that it's usually and often, but I would hazard to say that that's the case today, right?
Yeah.
Today, if you were to compare your fixed versus variable, the fixed is more than likely going to be less than what the typical variable rates are. And we'll get to that in a second. And so obviously, because your term is fixed and the payments are set for that specific period of time, I'm expanding the word if here, if the variable rate does happen to come down, somebody who's in a fixed rate will not benefit from that.
Yeah.
So
they're protected themselves from any change.
Exactly.
Be it a decrease in the rate or an increase in the rate.
That's right. So like we said, it really is mostly beneficial to people who tend to be risk averse or who are already on the tight side due to the mortgage size amount, and they wouldn't be looking forward to seeing very many fluctuations in their payments.
Yeah.
So yeah.
But anyway, anybody even opting for a fixed again is faced with a couple of other choices that they have to make.
Yep.
Like for how many years are they getting to that contract, right? Usually we see any periods anywhere between 6 months to 5 years.
Yep.
Some people may even go longer than that.
Yeah.
So again, even if one is the opinion to go with a fixed rate, there are still choices that they have to make within that scheme.
And we will talk a little bit about some of those things to consider after our next little thing, which is we talked about fixed rates. So what are variable rates? I mean, there is a fairly simple definition, and it's the interest rate will fluctuate based on the lender's prime rate, which is tied very closely to the Bank of Canada overnight rate. Yeah.
Yeah, there are a number of terms used, right? You have a policy rate,
yes,
you have an overnight rate, and then a prime rate.
Yeah. And
so prime rate is what is used by lenders.
Yes.
Policy rate is what Bank of Canada comes out with an announcement around.
Yes. Does every lender have the same prime rate?
For the most part, yes, except for one green bank. I wonder why they are different.
Yeah. Well, we won't go there, but it is enough to point out that not every lender, unfortunately, treats this the same. So if you are dealing with or facing the question of should I take a variable, that is definitely something to look into because it matters.
Yeah. And you touched upon how it differs from fixed in terms of the fact that the interest rate fluctuates in this type of a mortgage. But again, there are two implications or two variations in terms of how this is offered by different lenders and banks.
Yep. So when thinking of a variable interest rate, before we get into the pros and cons, let's talk a little bit about, we've talked about how it's set. So the Bank of Canada has an announcement and the banks typically follow suit. Now, a lot of people probably don't know that the Bank of Canada actually meets 8 times a year to discuss and decide what they're going to do. And then they announce it at these meeting dates. The meeting dates are set typically before the end of the 1 year or the entire next year. So before December 31st, 2024, we should be seeing something on the Bank of Canada website that says, here are the fixed announcement dates for the variable interest rate product.
Yeah. I don't think they've come out yet, but yeah, they should be coming out shortly this month, publishing their calendar for 2025.
Yes. So those are dates that are set. They're put in place. They're only set for 12 months in advance, not 24 or anything like that. But what that means is, as Neil and I are mortgage agents, brokers, and we're doing everything we can to look after our clients, we are eagerly listening to the results of those meetings so that way we can inform our clients accordingly. I mean, obviously, on top of that, we're doing many other things for that purpose. We're watching what's happening with the economy. We're looking at what the economists are saying. We're looking at what's happening all over the place. And doing our best to interpret all of the information in order to try to be a little bit ahead of the game of what we think the Bank of Canada is going to do.
Yeah. For a long time, these meetings have not been of great consequence, at least to the common man. But lately, I think the last couple of years, the focus of these meetings has definitely increased, right? A lot of people are following. It's always in the news.
Yes.
And it will probably continue to be for the next little while.
Yep. So let's talk about some pros and cons. Variable interest rate. Can you name one of the first pros that comes up the top of your head?
Well, as mentioned before, variable rate are based off short-term rates, and short-term rates generally tend to be lower than the longer term rates, which are typically associated with fixed rates. So, in essence, what it means is that variable rates are generally lower than comparable fixed rates.
Yes. Yes. And we have history that tells us so, right? The longer the period of time we use in order to compare the fixed against the variable, you would see that the variable has a tendency to track lower than the actual the fixed rates that are available during that time period.
Yeah, the long-term variable rates would be lower than the long-term average fixed rate.
Yes.
But again, it's all a function of where you're getting in, and so it may not be the same in everybody's case.
Nope, that's right. Where we're at today, so we talked a little bit, or we touched on it already, that today's variable interest rates are higher than the fixed. So if you were to look at a 5-year variable, I think our going is maybe prime minus 90,
Yep.
Ish.
Yeah, depending on the type of mortgage. Yep.
Yep. And so that's putting us right at around the 5% mark in a lot of cases. Whereas the best 5-year fixed, in most cases, if you average between conventional and insured, we're probably sitting at around 4.5, or maybe 4.6, maybe. Yep. But 3 years ago, in 2021, the variable interest rate at prime minus 1.1 and 1.2 was sitting at an interest rate, or an end rate at the time, at about 1%, and the fixed were at around 2 or 2.25.
Yeah.
So they've inverted since then, that time.
Yes. Generally speaking, over a period of time, variable rates tend to be lower than fixed rates.
Yes.
But again, you are at certain points in time where the relationship doesn't hold.
Yeah. Yeah. So I think another good pro to the variable, as we've been discussing, is that when the Bank of Canada drops because of their short-term lending whatevers, you'll see a drop in a variable interest rate, whereas you will not see a drop in the fixed. There is not a direct correlation between the two. So the advantage is that you have a tendency to see a rate drop in a variable, whereas you typically won't. Obviously won't in a fixed rate.
Yeah. For a mortgage holder, that doesn't make any difference. Meaning, once they get into a contract, like a fixed rate contract, nothing changes for them.
Yeah. So on the flip side of the pro and the opportunity to potentially save because of those rate drops, one of the first cons is the absolute inverse of that, which means that the rates could go up too.
Well, yes, there is no protection. Right. It's an increase or a decrease.
Right.
Now it may make a difference, because depending on the kind of mortgage they have, their payments may not change or may change.
Yeah, because there's two different types of variable. One is the variable where, generally speaking, the payment stays the same, only the amortization changes. And then the other is an adjustable, where your payment actually goes up and down, but the amortization, the overall length of time it takes to pay that mortgage off, continues at its same pace. So I
just wonder how many homeowners out there do not really understand the nuance between a fixed payment variable rate and a fixed rate mortgage.
Yeah. I bet you there is a lot. Unfortunately. And that is, it's on obviously the borrower themselves, right? Caveat emptor, as the saying goes, buyer beware. So if you are signing on the dotted line for a variable rate mortgage with one of the bigger banks, where they actually have fixed payment variables, and you didn't understand that ahead of time, that's technically on you as a borrower. And that's part of the reason why we're doing these conversations, is to help educate you, so that way you can get your shit together, right? And understand what you're signing. Because, it's nobody else's fault, right? Like when we sign something, we put pen to paper, we're either scammed big time or we just simply didn't take our time to understand what was going on.
Yeah, and as long as you have signed it, most likely you will not win that argument. Yes, so another flip side of variable rate mortgage tends to be that the homeowner or the borrower choosing such a product should be probably a bit more risk tolerant when it comes to changes in their monthly payment or their ability to pay more interest because just suddenly their amortization period has increased. Or rather, the repayment period has increased.
Okay, so obviously there is a lot of things to take into consideration. What are a few considerations or factors to consider when trying to decide, like very specifically laid out? What are things to consider when you're trying to decide, do I take a fixed rate today or do I take a variable?
So there are a few general factors that you can consider, and again, I mean general macroeconomic factors. There could be additional factors that are specific to your situation, and so that requires a certain another discussion altogether with the individual. But generally speaking, one of the key determinants of before choosing a fixed or a variable is to understand what is the current rate environment. Are we looking at a period where rates are increasing, or are they decreasing, or are they just stable? So knowing where you are is good before you make a decision to choose a path.
So when looking at the current rate environment, it's not only important to look at just what's going on in your own situation. You know, can you handle a 4 or a 5% interest rate or whatever? As far as like looking forward goes, what's happening outside? So you have your own situation to deal with, and everybody should know their own. And that's the only time I'll use should, really, is you should know your own situation very well. So you should have a good idea of what to expect over the coming months, years, et cetera, et cetera. If you feel very not confident in what your situation looks like, maybe because of potential layoffs, or, you know, is the industry that you're in changing at a rapid pace or something like that, maybe looking at the fixed payments wouldn't be a bad idea. But aside from that side of things, looking at what's going on in the general economy, I think, is also a pretty important factor. And I don't expect that everybody, you know, turns on the news or looks at the Financial Post to figure out what's happening in the economy. But I think at least being aware, are we in a tumultuous time, or are we in a period of relatively stable goings on, if you will? And I would think right now, probably the former is a good take. So, you know, for me, as an example, I think because I tend to be a little bit on the risk-averse side, I might choose the fixed term, but I might choose a shorter fixed term, right? Because Trump, tariffs, like all of these sorts of things are going to have an impact on what's happening in the coming months and years. And so to me, that leans towards tumultuous.
Yeah, and it's not to say that those things will materialize.
That's right.
It's just that there is no way for us to say with any degree of high confidence that this is how things would play out.
But it's like we said right at the beginning, it's best that you understand your own financial picture and situation. That is the thing that's going to help make the best decision for you. So looking at your financial situation quickly, do you have a cushion to absorb any higher payments if the interest rates did rise? You know, are you somebody that's living paycheck to paycheck, like a lot of people unfortunately are these days? And they may not have room in their budget to see any fluctuations.
Are you planning to move? Right, that could be a factor.
100%. That's a big factor. A lot of things can happen with a move. While there are benefits to being able to keep your existing mortgage, if you have to blend, or if you have to add more money and you need to blend in, you know, because you're moving up for example, your interest rate could go up. So could your payments.
Yeah, so there is another option, which is a hybrid option that borrowers can consider. Again, it depends on hybrid could be in different scenarios. Like maybe you have a mortgage which has multiple components. So you could choose a variable and a fixed to have some sort of a hybrid solution to you.
So
or if you have multiple properties, then you could choose fixed for some and variable for another and sort of balance it out. So there are different ways to approach and sort of hedge your bets.
So where do you and I come in when we're looking at these things for clients?
Where mortgage brokers come in is we look at the scenario that borrowers are in more objectively in terms of reviewing their financial situation, their plans for the upcoming years, and then we are able to recommend as to what might be a suitable option, not just in terms of what might be a fixed option, better fixed option, or a variable option, or a hybrid option, but we could also bring forth different lender options. Because not all lenders are the same, so maybe there are specific offerings which may be of more meaning to them, rather than what their bank is willing to offer or placing for them.
Yeah, we take a lot of your information into consideration and then present you back with some options. And sometimes those options come with explanations, which is the reason why we're offering you the 5-year fixed is because of this. The reason why we think maybe a variable might be good for you is because of this. Or the reason why a hybrid option might be good for you is because, right? And we're kind of we're still giving you, the borrower, the power to choose. We're just helping to educate you on all of the things.
Helping borrowers make a more educated choice.
So let's talk about a couple myths. Fixed versus variable. You got a myth you want to talk about? Yeah.
So I think it's incorrect to assume that variable rates are always lower than fixed rates.
Really?
Yeah.
Everything that we've just said hasn't.
Well, we said generally speaking.
Exactly.
But it need not be always.
Yes. Yeah. And just like we're saying it's a myth that the variable rate is always cheaper, that doesn't always mean a fixed rate is always safer either. And the reality is, while it's only stable during its term, you have no idea what's happening elsewhere with the tumultuous world that we live in and what's happening with rates. So again, we'll talk back to, people who are taking a fixed rate at 2%, or 2.25% in 2021 for 5 years, and they're coming in to the renewals that we talked about earlier as well. And where are rates today? Like 4.5%. And the fixed rates aren't always the safest bet either. Now, again, that's not to plant seeds of doubt in anybody's head, because you do still need to make a decision. You want a house, you need the mortgage or the loan. What's best for you is always going to be the answer to the question.
Exactly.
Yeah.
And going back to the what we were mentioning earlier, right? It is a forecast. You can never always come out on the right side of those forecasts. You will lose sometimes, you will gain sometimes.
Yep. But what I mean by that is, could you make a change? Right? So if you've chosen a variable interest rate, and, as many people in 2023 saw, like the rates jumped quite quickly. Could they have converted to a fixed?
Absolutely. Yes, absolutely.
Right? And so there was one option. Even if they didn't convert to a fixed then, could they convert to a fixed today? Yes, they could.
They can.
If you're in a fixed rate mortgage, now I am going to caveat this, that like 90% of fixed rate mortgages out there, you can break or prepay, as the lender calls it. But it does come with a penalty, and the penalty calculations are worse with some lenders than others. So one of the things that Neil and I do is when we're faced in these situations where somebody is looking at making a change, whether they want to refinance or, extend out the mortgage a little bit to make the payments a little bit lower or whatever the case is, we're always looking at what is the thing that makes the most sense for your situation. Some days you are going to end up paying a penalty. But if you didn't pay the penalty and kept going on the path you were, it could be a worse scenario in the end. So we're always looking at and working with you, and we're never making decisions on behalf of clients, but you say, I want to do this. What would that look like? We run some numbers, we put some things together, and then we give you some feedback.
Yeah. So you have something solid to go ahead with, right? Whatever your decision then on is.
Yeah. Do understand very clearly your own financial picture and your goals, and what level of risk are you comfortable with? That's your job as a borrower. I mean, that's my job as a borrower. I have a mortgage too, but that's your job as a borrower, is to understand that.
Yeah, understand what your financial picture is, what are your financial goals like, what is it that you want to attain,
yeah,
and then make a decision based on having considered all of those aspects.
Yeah.
Okay, these are generalized recommendations, whatever we talked about today. If you want any specific consultation, feedback about your situation, obviously it's best to reach out to either Jerome or me so that we can have that talk. So Jerome, at the onset of this episode, we talked about doing some sort of prediction about what Bank of Canada could do when they're meeting on the 11th of December.
Yes.
So what do you say? What is your call? Is it a reduction, a hike, a 0.5% reduction, or a 0.25% reduction?
I don't think it'll be a hike. And I feel from everything that I've read so far, I'm inclined to say that the 50 basis point reduction would be too aggressive. So I am going to make a decision, and my decision is going to be, I think they will reduce it by 0.25, so 0.25% only.
Yes, that's the most likely outcome.
Yeah.
We still don't know what employment numbers are going to do on this Friday.
Yeah.
As we record on the 4th of December, we don't know that.
Yeah.
So it could be a factor, but yeah, I think most safe bet is, of course, a 0.25% reduction.
Yeah. I wouldn't be surprised if they don't do anything. It wouldn't surprise me at all if they say, because of everything that's happening in the US, because of everything that's happening with our government, I don't know if everybody has read the latest about the CERB loans and anyway, they might just look at it and say, it's too early to make another change. We're going to sleep on it over the holidays and then come back in January with hopefully a bit of a fresher outlook, and then make a decision at that point. I personally, if I had to put like a percentage on it, I'd say I'm 55% that they're going to do a 0.25% reduction to 45% nothing at all. That'd be where I'm sort of sitting.
Yeah. It doesn't look like it's going to settle anytime soon in terms of where this all is going to land.
Yeah. And the reduction isn't going to stimulate anything, in my opinion. It's not going to stimulate the economy. It's going to make people breathe a little easier. It's like loosening the belt loop by one notch, right? Like, now it's still tight, but I can breathe a little bit better. And I think that's as far as they'll go because they want to see the outcome of that.
Yeah, and it impacts primarily only the variable rate mortgage holders. So it's anyway a smaller fraction of people who have mortgages.
Yeah. Do you know offhand? I don't. What are the typical percentages of people that have variable versus the people who have fixed? Any?
So I just looked at Scotiabank's report, their financial report for Q4, I think, and they just have about 30% of their book is variable rate mortgage. So I don't assume it's going to be way different with the other banks.
Yeah, probably not. So yeah, so I mean, it would impact, if they do make a change, it would impact about approximately a third of mortgage holders, effectively.
Yeah, and since the rest of the big five banks do not make changes to their payments, it's not going to affect from a cash flow standpoint as well.
No.
So it's only Scotiabank's 30% who are going to probably change the payment, and few other monoline lenders.
Yeah, exactly. Yeah. All right. Well, let's hopefully by the time this is airing, people will have heard what the response is, and we'll see if we're right or not. We're signing off for the holidays. Please have a happy holiday season. Christmas if you celebrate, Hanukkah if you celebrate, whatever else there is.
Wish you all a happy holiday and see you in the new year, 2025.